Imagine owning a business that practically runs itself, needing very little investment to grow, and rakes in cash year after year. Sounds ideal, right? Well, Warren Buffett, one of the greatest investors of all time, often called the Oracle of Omaha, built his success by focusing on companies just like that. Today, we're going to explore the kind of companies Buffett loves most, the ones with low capital needs and high cash flow, and we'll uncover exactly why these companies often make some of the best long-term investments. So, if you're looking to invest smartly, just like Buffett, keep watching. Oh, and don't forget to subscribe for more insights into investment strategies and how to build wealth. Warren Buffett, one of the most influential investors in modern history, has become synonymous with disciplined, long-term investing. Known for his unparalleled success, Buffett's investment philosophy centers around a key principle: choosing companies that are low in capital intensity and have strong, consistent cash flow. His focus on these types of companies isn't accidental. It's rooted in decades of careful analysis and dedication to investing in firms with minimal reinvestment needs. But why does he emphasize this so strongly? Simply put, companies that don't need to spend a fortune on maintenance or expansion can direct more resources into growth or return value to shareholders. Buffett often chooses companies that can grow without draining their profits by keeping the lights on, unlike capital-intensive businesses that need constant reinvestment. Let's take an example to make this concept clearer. Imagine two businesses. One is a small tech company that only requires a few employees and modest office space, while the other is a car manufacturing company that has to spend millions on factories, equipment, and materials just to operate. The car company is capital intensive, meaning it needs to keep pumping money into its infrastructure to produce products. Meanwhile, the tech company, which doesn't need a factory, has lower costs and keeps more of its earnings available for reinvestment or distribution to shareholders. This strategic advantage has helped Buffett build an investment portfolio that grows steadily, even during economic downturns. So, if you're interested in learning what Buffett looks for when choosing companies to invest in, stay tuned. The importance of cash flow over earnings. A common pitfall for new investors is to focus exclusively on earnings rather than cash flow. Buffett, however, has always stressed the importance of cash flow. To him, cash flow represents the actual cash a company generates, which can then be used for dividends, stock buybacks, or growth opportunities. This isn't the same as earnings, which might include non-cash items or be affected by accounting tricks that make a company look more profitable than it is. Think of earnings as the profit on paper and cash flow as the actual money in the company's pocket. Cash flow, therefore, is far more reliable for investors because it directly impacts a company's financial health and ability to deliver value to shareholders. Buffett's focus on cash flow is rooted in the understanding that companies with strong cash flow have more financial flexibility, allowing them to weather economic downturns and avoid unnecessary debt. Let's consider Apple as an example. It has generated enormous amounts of cash flow over the years, which has allowed it to pay dividends, buy back shares, and invest in new technologies without relying heavily on debt. In contrast, companies with weaker cash flow are often forced to borrow money to fund growth or pay dividends, which can be risky if interest rates rise or if the company hits a rough patch. Strong cash flow also makes a company less dependent on external financing, which Buffett sees as a key advantage. When companies can fund their growth, they're less vulnerable to the whims of lenders and less likely to be affected by changing interest rates. For Buffett, cash flow represents a company's ability to sustain itself and deliver value to shareholders in the long run, which is why he prioritizes it over earnings in his investment decisions. Low capital intensive versus high capital intensive companies. A critical part of Buffett's investment strategy is differentiating between low capital intensive and high capital intensive companies. But what does this mean? Essentially, capital intensity refers to how much a business needs to reinvest in its assets, like factories, equipment, or technology, to maintain its operations and grow. High capital-intensive companies require a lot of these investments. For example, companies in industries like automotive, oil and gas, or utilities need to spend large sums on infrastructure just to keep running. On the other hand, low capital-intensive businesses, such as software or consumer goods companies, can operate and expand without major ongoing costs. Buffett prefers low capital-intensive companies for several reasons. First, these companies have more free cash flow, which they can use to fund growth, reward shareholders, or strengthen their competitive position. Microsoft, for instance, doesn't need massive capital expenditures to maintain its business. Instead, it can reinvest in new technologies, acquire smaller companies, or return capital to shareholders through dividends and buybacks. This contrasts with companies like Ford, which constantly needs to pour money into plants and equipment just to produce their core products. For for Buffett, this distinction is crucial because low capital-intensive companies are often more adaptable and able to scale faster than their high capital-intensive counterparts. Additionally, companies that don't require large capital investments can often weather economic downturns more effectively. In times of financial stress, high capital-intensive companies might struggle to fund their operations or find themselves burdened by debt, whereas low capital-intensive companies typically have more financial flexibility. By favoring low capital-intensive companies, Buffett ensures that his portfolio is resilient and capable of delivering returns regardless of the economic climate. Why Buffett avoids debt-heavy companies. Buffett is famously opposed to debt-heavy companies. His stance is simple. Companies with little to no debt are more financially stable and better equipped to handle downturns or unexpected challenges. When a company has significant debt, a large portion of its earnings must go toward paying interest on that debt, reducing the funds available for growth or shareholder returns. In a tough economic environment, companies with high debt levels can struggle to meet their obligations, potentially putting their business at risk. For Buffett, investing in low-debt companies is a way to minimize risk and ensure a stable, predictable cash flow. To illustrate, consider two companies, one with a heavy debt load and another with minimal debt. The debt-heavy company may perform well in good economic times, but could quickly become overextended if the economy falters, interest rates rise, or its revenues decline. On the other hand, a company with little debt is in a stronger position to weather downturns and may even take advantage of opportunities that arise in challenging times. This low-debt approach is one reason Buffett is a fan of companies like Apple, which has a strong cash position and relatively low debt, allowing it to reinvest in its business, reward shareholders, and maintain financial stability regardless of market conditions. For Buffett, investing in companies with manageable debt levels also aligns with his broader philosophy of value investing. Debt can create volatility and increase a company's vulnerability to market conditions, which is the opposite of what Buffett seeks. He wants investments that will perform consistently over time, which is more achievable when a company isn't burdened by debt repayments or high-interest costs. By focusing on low-debt companies, Buffett ensures that his portfolio remains resilient, steady, and capable of delivering returns without the added risk that high-debt companies face. Competitive advantage and economic moats. One of the most famous concepts associated with Buffett's investment philosophy is the idea of an economic moat. A company's economic moat is its competitive advantage, the unique strengths that protect it from rivals and allow it to maintain market dominance. Companies with strong moats, such as Coca-Cola or Apple, enjoy brand loyalty, proprietary technology, economies of scale, or other advantages that make it difficult for competitors to replicate their success. For Buffett, investing in companies with wide moats is a way to ensure long-term stability and consistent returns. Buffett favors companies with economic moats because they can maintain profitability and pricing power even in competitive markets. Take Coca-Cola, for example. Its brand is recognized worldwide, and consumers are willing to pay a premium for it. This brand loyalty acts as a barrier to competitors, allowing Coca-Cola to maintain its market position and generate reliable cash flows. Another example is Google, which dominates the search engine market. Google's algorithms and data give it a massive advantage, making it nearly impossible for new entrants to compete on the same level. Buffett's focus on companies with economic moats aligns with his long-term investment philosophy. By choosing companies that are difficult to disrupt, he creates a portfolio that is resilient to market changes and competitive pressures. Moats give companies the power to maintain strong cash flows and return on investment, which is critical for long-term growth. This emphasis on durability and stability is a key reason why Buffett's investments consistently outperform the market. By focusing on companies with robust economic moats, Buffett ensures that his investments are secure, profitable, and capable of thriving in the face of competition. High returns on equity. Another essential metric for Buffett is return on equity, ROE, which measures how effectively a company uses shareholders' equity to generate profits. A high ROE is an indicator that a company is using its resources efficiently and generating strong returns for its investors. For Buffett, companies with high ROE are attractive because they don't need additional investment to achieve significant growth. They're able to reinvest their profits and grow internally. This contrasts with companies that require constant external funding or debt to maintain their operations. Apple is a prime example of a high ROE company. With its strong brand, efficient operations, and loyal customer base, Apple can generate substantial profits relative to its equity, making it highly efficient at converting resources into income. This efficiency allows Apple to fund its growth, pay dividends, and buy back shares, all while maintaining financial stability. For Buffett, high return on equity is a sign that a company is well managed and capable of delivering consistent returns without needing to rely heavily on debt or outside funding. Conclusion and final thoughts. Buffett's investment approach, focused on low capital-intensive, cash-generative companies with competitive advantages and high ROE, provides a roadmap for anyone looking to build wealth over time. His strategy is not about finding the trendiest stocks or betting on speculative plays. It's about identifying solid, resilient businesses with the potential for consistent returns. Buffett's favorite companies have predictable cash flows, limited capital needs, minimal debt, and strong economic moats. By focusing on these factors, he's able to build a portfolio that can weather economic downturns and produce reliable returns. Whether you're a seasoned investor or just starting out, these principles offer invaluable insights into creating a sustainable investment strategy. Make sure to subscribe if you found this video insightful and hit the notification bell to stay updated with more in-depth investment tips inspired by the strategies of one of the greatest investors of all time.